Let's bring in StoneX Chief Market Strategist Kathryn Rooney Vera. Kathryn, you are urging caution. You think this rally is running on fumes and we're not seeing 5,000 next year, at the end of next year?
Well, what has taken us to current heights? The resiliency of the U.S. consumer has been due to big transfer payments to their check accounts. That's evaporating. That's going away. The pandemic
But we have
checks
credit cards.
Right, we have credit cards. But credit cards are more costly now. So you can run them up, but it's going to cost you. So banks are tightening credit. 50% of all banks are tightening credit. And if you get credit, it's very expensive because, as we all know, the Fed has increased 525 basis points over the course of a little more than a year. So credit is harder to get, more expensive to get. Discretionary spending is likely to decline. Real rates, which is Fed funds minus inflation, are now positive and moving higher. And you have an additional headwind, which is the resumption of having to pay your debts that you took out as a student. So all of these, I think, Lauren, are headwinds to the main driver of the U.S. economy, which is de facto consumption.
And that's what a lot of these retailers have come out and warned as they're reporting their third quarter earnings and giving forecasts on the holiday quarter. Speaking of the holidays, I mean, will there be a Santa Claus rally?
There almost always is.
Okay.
So more likely than not.
So your pessimism is next year?
Yes, I think that we're moving into a year where the S&P is currently pricing in 12% earnings growth, which is the equivalent of about a 6% nominal GDP growth, which I think is a very optimistic scenario. How can companies continue to expand their margins when they're still affected by the triple whammy of high labor costs, high energy costs, which is an input, and high real rates? I think that's an unlikely scenario, and I would be hedging your bets, at a minimum protecting your portfolio against a risk-off environment next year.
What would you buy?
So in the equity space, I would buy the defensive sectors that historically outperform, Lauren, in either stagflation or recession. Those are staples, utilities, which is a bond proxy, boring ones, not sexy ones. I've talked about this with Charles. It sucks, but it is what it is. And you know what? When things turn ugly, everybody starts to love these sectors. Right now, they're beaten up. I wouldn't be chasing the rally. This FOMO is coming back. Everybody's getting excited about NVIDIA. But the truth is that the breadth of this rally is so narrow. We all know the story, that I think it's susceptible to downside.
Okay. Final question. You are very tuned into what's going on in the third biggest economy in Latin America, Argentina. Now you have a libertarian, a Trump-esque type of guy as the new president.
Yes, and bonds have rallied. YPF has soared in terms of its equity price because he's talking about privatizing this company, and we know that the private sector does a better job of making money than a government-run entity. So yeah, he's talking about dollarizing the economy, privatizing national enterprises, making the economic freedom robust again, and that is why you have YPF soaring 40%, and that's why you have bonds rallying double digits.
And taking inflation down from 140%.
Whatever that was not working. It was time for a change.
They want dollars, and now they might get them. The dollarization of the economy.